Mr. Patra, thanks for joining us. What were the average NSR for Nalco given the surge that we've seen on the LME during Q4?
As I told in this, in the recent past, in this quarter, the price highest reach is around 2565 metal price LME, but it could not sustain for a long period with that price, and it reduced again to 2,400. Now it is hovering around 2,400 to 2,500. But the market speculation is that the price will prevail in fiscal 21 and 22, both around 2,250.
Okay. Though, alumina prices have started increasing, the up move, hasn't been as strong as what we've seen on aluminium, for instance. So what's the outlook there, and what are the expected NSRs for you there?
Actually, it is basically based on the LME and where the products of across the globe they trade. So the trade war between any two countries will have some impact definitely, because this metal is the greener metal and it is the best preferred metal over all the metal for all the multi-purpose use. So whether it is a China trade war between China and Australia or US or Russia imposing import duty, all these things will have an impact. Time has to come and we have to see how it is impacting. Because supply and demand forces are also major factors. Due to this pandemic, the full swing production have not yet started, and industry which was shut down, they are also starting. It is not full-fledged. So various factors determine the price and supply demand forces.
And given the fact that we have seen alumina prices starting to increase, the up move hasn't been quite strong that we've seen in aluminium. What is the outlook there, and what is the expected NSRs for the company there?
LME 2,500, what we expect, it is not sustainable in the long term for all the industry. So definitely 2,500 will not prevail throughout the year. But about 2,300, I feel it will be the LME. And in the international market, if you see, so far metal production's consumption and demand is concerned, sometimes production is marginally higher, sometimes demand is marginally higher. And in these fiscal years, we expect that the demand will be more than the production. Because the industry, when they restart, it will be requiring more metal, and it is the intention of every trader to stock adequate quantum for the entire supply chain. So for these reasons, the demand is likely to be slightly favorable than the production. So we hope that this second quarter of this financial year also will have a better LME.
Mr. Patra, your cost of production has been quite low, but this is only on account of the one-time reversal of renew obligations that we saw with Odisha Electricity Board. Are you going forward seeing your input cost pressures easing?
First of all, I will say cost of production, it is basically internal matters for our internal control purpose. But during this year 2021, we have taken various strategic decisions with a calculated risk. And that risk has remunerated us. Grossly speaking, that risk has remunerated us.
Okay, the Utkal E mine lease was recently granted to you. With that and Utkal D, how much raw material now is produced captively, would you say? And how can it help you, in fact, in hedging against commodity inflation?
Fundamentally speaking, for the present size of smelter of us, around 4.6 lakhs tons of capacity, normally we require around 70 to 75 lakhs tons of coal. And at present, we have bridge linkage, coal linkage, and we are also depending upon the e-auction. But after Utkal D and E have been operationalized, the full-fledged capacity will be 4 million tons. So this cost of production vis-a-vis the cost of purchase from the MCL and other subsidiary of Coal India, there will be definitely a margin of 200 to 300 rupees. Comfortably, somebody can guess. So that will add to the profit and it will reduce my further power cost. It will give 2 cents. One is it will increase my bottom line. And second thing is when it is reduced, the volatility of LME can be better accepted or better handled by the company.
Jackson Capex awaiting commissioning. Give us a targeted timeline for all of these, including, the Utkal D 1 million ton alumina refinery, for example. There are still some investor concerns on slow execution.
We have a capex target of 1,800 crores during this current financial year, which is giving mainly thrust on the 2 projects. One is our 15 refinery expansion, and based on the progress payment and commitment, etc., around 1,100 crores is likely to be cash outflow. And another 600 crores we would like to spend for modification and replacement of our existing operation plant, so that to keep the plant healthy, and it will go a long way along with the new unit which is coming up.
All right. Thanks so much for joining us today, Mr. Patra, and running us through some of the key factors at play there for Nalco. We're going to take a very quick break. We'll be right back.